Welcome to Hybrid Market Terminal Podcast, where macro meets momentum and strategy drives every move. And welcome to the deep dive. Today, we are immersing ourselves in really the absolute fundamentals required to move beyond just random trading.
Yeah, to build a successful, long-term, repeatable process.
Exactly. We've synthesized a massive collection of insights, heavily influenced by what the trading world has dubbed the Trader's Handbook.
It's a fantastic resource. It pulls together the collective wisdom of 4 really seasoned traders: Richard Moglen, Schmidt, Haber, and Ameet Rai.
And you're talking over 6 decades of market experience combined. A lot of it steeped in that, foundational William O'Neill tradition.
It is, and it's a powerful foundation. One that doesn't shy away from the granular detail either. Dr. Eric Wish, in his foreword, he actually validates that approach right away.
Well, what did he say?
Well, he noted that while a lot of trading books talk philosophically about patience or discipline.
Right, the high-level stuff.
Exactly. This book provides the, and I'm quoting here, excruciatingly detailed specifics, especially when it comes to the mechanics of risk management.
I love that. And the lineage here is really strong, isn't it?
It's incredible. Haber, one of the authors, he was a protege and a former portfolio manager at William O'Neill Plus Co.
Wow.
So this is truly a combined approach of classic time-tested methods and, how to actually apply them in the modern market.
So our mission today is pretty straightforward. We want to extract the core wisdom from these decades of hard-won experience. We want to give you, the listener, a fast-track blueprint to developing those successful long-term trading habits, the kind derived from legends like O'Neill, Stan Weinstein, Mark Minervini.
The principles is just keep working.
That's it. Principles that work regardless of the market era or the latest, tech wave. Okay, let's set the stage, and I want to speak directly to you, the trader tuning in right now, because this material, it really addresses a specific recurring pain point.
Yeah, very common one.
Are you tired of trading feeling like a high-stakes gamble, where every single decision feels like a toss of the dice? Do you experience that rush of a bull market when watching your account just soar to new highs, only to then see all those hard-earned profits systematically erased when the market inevitably turns south?
The give back, it's brutal.
It is. Do you feel truly like you're just stuck in that frustrating and ultimately unprofitable boom and bust cycle? If that's you, then this deep dive is your blueprint. It promises a clear, actionable, step-by-step methodology.
And this isn't about the flashy stuff.
Not at all. This isn't about finding the next meme stock or chasing quick, unsustainable profits. It's about the hard work. It's about the detailed process, the discipline required to trade profitably over the long term.
That's the key phrase.
You will learn the specific, practical rules you need to navigate market cycles and, crucially, to stop giving back your hard-earned capital. So here is the core promise of absorbing this material. After you engage with these concepts and really commit to the process, you will replace those random impulse trades, chasing tips, succumbing to fear and greed, with structure, discipline, and routine.
A real business operation.
You'll begin to move your equity curve away from that frustrating volatility and toward the much coveted consistency and performance stages. Instead of losing capital during downturns, you'll start reliably compounding it through every single cycle.
That transformation is just...
Oh.
It's fundamental. What's fascinating here is that the authors are absolutely clear that trading success is not about finding the perfect signal.
No.
Or, timing the top and the bottom perfectly. That idea is a complete myth, one that's really perpetrated by social media.
Absolutely. The memorable takeaway line that anchors this entire discussion, and the one we really want you to carry forward, is this: trading success is about earning the right to size up.
Earning it?
By mastering risk management and process and refusing to quit when setbacks inevitably arrive, it is fundamentally about process over prophecy. So let's start with the hard truth, because the authors are incredibly upfront about the competitive reality here.
They don't pull any punches.
Not at all. Trading is anything but easy. We know the barrier to entry has never been lower. You can open an account with a commission-free app in, 5 minutes?
Yeah, it's trivial.
But success, that requires years of commitment, hard work, and developing a time-tested, structured process.
And you have to accept, from day one, you're competing in the same arena as quantitative hedge fund managers.
And veteran floor traders with decades of specialized experience. You're not playing against amateurs.
That perspective is so crucial. You have to approach trading not as a hobby, but as a sophisticated business venture. And to survive and thrive in that intensely competitive environment, successful traders, they fully embrace 5 core disciplines.
Okay, let's unpack those 5 key principles. They really act as the foundation for the entire system.
All right, first one. Keep it simple.
Sounds easy.
It's the hardest one. Robustness in a system comes from avoiding complexity. Your focus should be on price action above all else. Maybe, supplemented by only a few key indicators.
Like moving averages.
Most commonly, moving averages, yeah. Just to avoid what they rightly call analysis paralysis. If you look at your chart and you just feel overwhelmed by lines and signals, you've moved away from simplicity. The signal has to be clear and objective.
Okay, that makes sense. What's number 2?
Second, stay focused. Success is born from specialization, not from generalization.
Being a master of one thing.
Exactly. You have to master one style, whether that's day trading, swing trading, or position trading for months at a time. And then within that style, you focus on only a handful of stocks and a handful of chosen setups. You're aiming to be the world's leading specialist in your chosen niche.
Now, focusing on only a handful of stocks, as you suggest in Principle 2 for a beginner, isn't that a little counterintuitive? Don't they feel like they need to see more charts to learn? How do they combat that fear of missing out on the stocks they filtered out?
That's a crucial distinction and a great question. Early on, you do look at many charts for learning, but you trade only a few.
Oh, okay.
The specialization comes in the execution phase. That fear of missing out is exactly why beginners fail. They spread their risk, they dilute their focus, and they become, mediocre at 20 setups rather than mastering one.
So by focusing on a narrow list,
You develop an intimate knowledge of those stocks' personalities, how they behave. And that is a massive competitive advantage.
got it. Okay, Principle 3.
Third, plan for failure. This is maybe the most humbling and critical principle, but it's the one that ensures your survival.
So you're saying expect to lose.
You must expect drawdowns. You must expect losing streaks that last for weeks, and yes, even periods of just plain bad luck where the market chops you to death. Your system has to be resilient enough to protect your capital when you're trading at your worst, not just when you're at your best.
That built-in failure planning, that really is the key to long-term success, isn't it?
It's non-negotiable, which leads right into the fourth one. Manage risk tightly. Your losses have to be inconsequential.
Paper cuts.
They must be small paper cuts that one good trade can easily cover multiple times over. This means mastering the skill of entering a high-potential stock and set up with a tight, and most importantly, a logical stop-loss.
And the authors argue if you can master just that one skill.
If you can master controlling the downside, you will succeed. The wins will naturally take care of the upside.
And the last one.
And finally, number 5, think in cycles. You have to ensure you are aggressive when the overall market trend is favorable, pressing the gas, sizing up. But you must be highly defensive and pulling back exposure during corrections or choppy periods.
So you're constantly adapting.
Constantly. Trading is a process of continuous adaptation and improvement. It's never a fixed, static state. The market environment dictates your behavior.
That structural thinking is vital. The market isn't a flat road. It's a dynamic series of peaks and valleys, and your strategy needs to adapt its posture constantly. And speaking of journeys, the authors provide a really powerful framework for understanding exactly where you are right now.
Defined by the ultimate truth teller.
Your equity curve. This journey has 4 distinct stages, and every successful trader has to progress through them sequentially.
No skipping steps.
No skipping steps. First up, stage 1, the unprofitable stage. If you're here, your equity curve is volatile, it's whipsawing, and it's trending downward.
It's a painful place to be.
It is. Your trading actions are random. You're trading based on hot tips, social media buzz, pure emotion. There's a complete lack of a written system, no defined risk management, and definitely no consistent use of stop losses.
For losses, just run and run.
They run far beyond acceptable limits. The progression, the way out, is to fundamentally commit to learning. You have to write your first set of objective rules, define your stock selection methods, and implement some basic risk management, especially stop losses. The goal is just to survive and stop the capital hemorrhage.
And this next stage, this is where most committed traders, the ones who've read the books and built the watch list, this is where they get stuck for a long, long time.
That would be stage 2, the boom and bust stage. Your equity curve is still highly volatile, but it generally trends with the market. You make money in bull runs.
But then you give it all back.
You give back all those profits, and sometimes more, when the market turns down, hence the bust. You're aware of strategies, you've read the books, but you struggle terribly with consistent implementation and critically proper risk management in real time.
And you're chasing everything.
Oh, totally. You're obsessed with indicator hopping, trying every new strategy out there, looking for the silver bullet that just doesn't exist. The way forward here is specialization. You have to focus intensely on one time frame, one specific strategy, refine your rules for position sizing, for stops, for selling. The whole focus is gaining highly focused, specialized experience.
And that transition from stage 2 to stage 3, that's the monumental step. It's turning that chaotic behavior into durable, consistent capital preservation. It's the shift from gambling to calculated business risk.
Which brings us to stage 3, the consistency stage. Finally, your equity curve is trending upward, and significantly, it's forming higher lows.
That's the key technical signature right there.
It is. It means you're protecting the profits you make from one cycle to the next. You're following a defined written system, you have sound risk management, and you have a strong, adaptable awareness of market cycles.
So what's the progression from here?
Mastery. You master a small handful of setups, you trade in sync with medium-term cycles, and critically, you refine your entries to be incredibly tight and logical. And the reason for that focus on tight entries is because tighter entries let you define risk more precisely. That means you can maintain the same dollar risk while increasing your position size for maximum leverage on your high-conviction trades.
And that leads to the elite level, stage 4, the performance stage.
This is characterized by a sharp upward trend with significantly higher lows. Your drawdowns are minimal, your performance is exceptional during high opportunity periods, and any drawdowns you have are limited and quickly recovered.
You've achieved mastery of your system, your routines, your risk dial. You know exactly when to press on the gas with maximum capital and when to step back.
Exactly. The learning never ends, but now the focus shifts from foundational stuff to efficiency, optimization, and anticipating even shorter-term market cycles. It really sounds like an apprenticeship, demanding years of commitment.
It is exactly that. And if we connect this to the bigger picture, the authors stress this is not a quick fix. It's not a goal you achieve in a single year. Most top traders take about 2 full bull-to-bear cycles.
Which could be, what, 5 to 7 years?
5 to 7 years,
Yeah.
to reliably reach stage 3, the consistency stage. This context is so essential because it highlights why that initial commitment has to be powerful enough to persevere through multiple setbacks. Every loss, every drawdown, it has to be viewed objectively, non-emotionally, as a specific learning opportunity you need to refine and strengthen your system.
Okay, let's transition from the mindset to the technical mechanics, the actual language of the market found in the charts. The core advice from the handbook here is just brilliant in its simplicity.
Keep your charts clean.
Keep your charts clean. Focus almost exclusively on price and volume. Avoid that common beginner mistake of analysis paralysis from overlaying too many indicators or confusing signals.
That is such a powerful principle. They advise using moving averages as essential trend identification tools, but as guides, not as gospel.
Can you give an example?
Sure. The 21-day exponential moving average, the 21 EMA, it's highly sensitive to recent price action, so it's great for swing traders tracking short-term health. On the other end, you have the 200-day simple moving average, the 200 SMA. It's the least reactive, and it provides the absolute macro trend filter for position traders.
So they're reference points.
They're reference points. The precise value is less important than the overall slope of the MA and the general area around it.
I really appreciate the practical instruction on reading a single price bar. It's not about, memorizing complex Japanese candlestick names.
No, not at all.
It's about fundamentally understanding the underlying power struggle that's happening during that specific time interval.
What's fascinating here is viewing a price bar, whether it's a daily or a weekly bar, as a simple tug of war between institutional buyers and sellers. Buyers push the price toward the high, sellers pull it toward the low, and you can objectively quantify who won that fight using the closing range formula.
Okay, let's walk the listener through that formula because it's a crucial technical measurement of buyer commitment.
Absolutely. The closing range formula is you take the close minus the low, divide that by the high minus the low, and then multiply by 100.
Let's use a quick hypothetical.
Okay. Imagine a stock trades with a low of $100 and a high of $105. That gives us a range of $5 for the day.
Got it.
If the stock closes at $104, the calculation is $104 divided by $105. So that's $4 divided by $5, which is 80%. A close at 80% means buying pressure was significantly stronger. The stock closed near its high, suggesting a constructive, aggressive bar the buyers controlled.
And conversely, if it had a high of $105 but closed way down at $101.
Then the calculation is $101 divided by 105, $100, which is just $1 divided by $5, or 20%.
Okay.
Precisely. A close at 20% is just the buyers failed and the sellers dominated the second half of the session. That's a potentially problematic bar. This subjective metric helps filter out the emotion, but this raises a non-negotiable question. What's the context?
A single bar doesn't tell the whole story.
Never. A single bar's action must always be taken in the context of the larger pattern. A weekly or monthly chart will always supersede the action you see on a daily or intraday bar. That higher time frame provides the overall structural story.
Okay, moving on to volume, which the authors emphasize measures conviction. If price is the motion, volume is the fuel. They advise using a moving average, like a 20-day SMA for swing traders, to judge if volume is truly high or low.
And their definition is pretty clear. High volume means 25% or more than average. Low volume is 25% or less. And that high volume during expansion, like a powerful base breakout, is crucial.
Why is that?
It indicates high demand. The authors call it the elephant tracks. The institutional investors are showing up, suggesting a powerful and durable trend is underway. Institutions need that large volume to enter a position without moving the price dramatically against themselves.
And what about the opposite? What does low volume tell us?
So conversely, low volume during periods of consolidation or price tightness is extremely constructive. It indicates that supply is drying up.
The sellers are gone.
The sellers have largely exited the market. This coiling of a spring where volatility contracts often precedes an explosive momentum move. Institutional money might be subtly accumulating during these quiet periods.
So, using this price and volume data, how do we formally define and track a trend?
We use two powerful complementary methods. First is market structure. An uptrend is simply defined by making higher swing highs and higher swing lows.
And what's a swing point?
It's typically a high or low that hasn't been overtaken for at least 3 bars, which gives it significance. Until the stock changes that structure, like making a definitive lower low, the uptrend is technically intact, even if there are pullbacks along the way. This is the oldest, most reliable trend measure.
Okay, and the second method?
The second is using moving averages. An uptrend exists if the stock is moving higher above a rising MA. You have to select the MA that's appropriate for your time frame, a 10-day for short-term swing traders, or the 200-day for long-term position traders.
Yeah.
Leaders, like a hypothetical NVDA or AMD during a powerful cycle, often respect that 21-day EMA area consistently. They only really breach it during major market corrections.
Now let's bring those concepts together with multi-time frame analysis and confluence. The market is fractal, meaning these patterns repeat across all time scales.
Right, and a trend is inherently more powerful and reliable when it's aligned across multiple time frames.
That alignment is what you call confluence.
Exactly. If a daily breakout aligns perfectly with a key weekly level, or if the 200-day SMA lines up with a past historical resistance point like an IPO high, that confluence significantly increases the likelihood of an actionable pattern holding true.
So these higher time frame levels act like magnets.
Powerful magnets. Yeah. They are checkpoints where institutional money is known to be active, guiding the lower time frame action.
To give the listener a checklist, the authors compiled traits shared by almost all top-performing stocks, the ones that double or triple from the mid-90s onward. This is really the blueprint for finding the next leaders. So what are these 7 winning characteristics?
These are the edges that tell you a stock has the right character for aggressive growth. First, a sustained increase in average volume. This signals institutions are actively involved in increasing liquidity. Second, huge volume spikes, especially on base breakouts or strong earnings, confirming big, decisive accumulation.
This is where that Oliver Kelsing comes in.
Yes, volume equals price, cause equals effect. The cause is the fundamental catalyst. The effect is the price explosion that's fueled by all that volume.
Okay, what's third?
Third, tight areas on low volume. This is that desirable coiling action, a lack of sellers and subtle accumulation during pauses. It shows the weak hands have been shaken out. Fourth, respect for moving averages. Strong leaders hold specific MAs like the 10-week SMA or the 21-day EMA for extended periods. When a leader starts losing respect for that MA, closing below it repeatedly, it often signals a fundamental change in character.
All right, and what are the final 3 signatures of a true leader?
Fifth, powerful prior moves.
Ooh.
This highlights the principle that strength breeds more strength. Winning stocks tend to keep winning after a corrective period. Sixth, gap ups. especially around earnings. They are a key signature of market leaders because they signal the stock is being fundamentally revalued overnight.
And the authors have a note about when those gaps occur, right?
They do. The earlier the gap happens in the stock's overall move, the higher the probability it matures into a full multi-month trend. A gap late in the move often signals exhaustion.
And the last one, number 7.
And finally, and this is crucial, relative strength, RS. The stock is demonstrably outperforming its peers and the general market, especially during a broad market correction. The RS line, which plots the stock's performance against the index, should be in a clear uptrend, often making new highs ahead of the price itself.
The example they used was Zoom in 2020.
A perfect example. ZM continued to consolidate or even advance on 61% of the days during that sharp market correction before its massive run. That kind of resilience is gold.
The final concept here is essential for managing risk. Learning Stark character. Stocks aren't all the same. Some are steady trenders and others are violently choppy traders.
Right, like low float small caps. This character is based on 3 factors. Liquidity, higher dollar volume usually means cleaner trends. Float, lower float means higher volatility. And life cycle.
Yeah.
IPOs are very volatile before the lockup expires.
So how do you manage that volatility and control risk?
To manage this, the authors suggest using average daily range, ADR%, to filter your universe. For growth and momentum traders, focusing on stocks with an ADR of about 3% to 5% strikes a sweet spot.
Why that specific range?
Well, if the ADR is too high, say 10% or more, it becomes prohibitively difficult to place a tight logical stop loss while maintaining a proper position size. But on the other hand, stocks with only 1% ADR are often too slow for momentum traders. It's all about finding the stock personality that fits your specific style and risk tolerance. Now, if we connect all that technical analysis we just discussed to the bigger picture, it all leads back to the institutions.
Right.
Institutional investors, they account for 90% of trading volume. They're the ones driving the sustained multi-month moves, and they are seeking increasing expectations for future earnings and rapid demonstrable growth.
Which is why the stock selection framework has to reflect that institutional demand. It's why the authors adapt William O'Neill's foundational Cancelim method. They distilled their specific criteria into the powerful TIGERS acronym. It's designed to filter out the mediocre names and focus attention solely on potential market leaders.
Okay, let's unpack this detailed framework.
Let's do it.
T is for theme. You need to identify and ride a strong, multi-year growth wave. The authors prioritize transformative themes like AI, semiconductors, cloud infrastructure over cyclical ones like energy or banks.
And there's a good reason for that. Transformative themes offer a much longer runway for growth, and they justify higher valuation multiples, which is what institutions crave. You look for that powerful confluence of 3 waves: the overall market trend, the group or theme trend, and the individual stock strength. If all 3 are in sync, your conviction goes way up.
Okay, next is I for innovation. The company has to have a unique value proposition that gives it a true competitive edge.
A new, game-changing product, a disruptive service, or maybe a significant leadership change, like the turnaround story under Dr. Lisa Su at AMD. This innovation provides the catalyst for that rapid future earnings growth. Then we get to G for growth. This is the hard numbers part.
Yep, no fluff here.
Quarterly EPS or sales growth should be at least 25%, ideally accelerating, and even triple digits in the explosive early stages of a theme. The fundamentals have to rigorously bag up the technical strength on the chart. If the chart looks amazing but the growth is mediocre, that's a big red flag.
Huge red flag.
Next, E is for edges. The chart must display those signs of high institutional demand or accumulation, the winning characteristics we just covered. These are the volume patterns and the relative strength that signal big money is already involved. Then R is for relative strength. The stock has to be a standout performer compared to its peers and the general market, proving its resilience, especially during market weakness. And finally, S is for setup. After all that, the stock must be forming a specific actionable chart pattern that allows for a tight, high-probability risk-reward entry.
So once you selected the stock using TIGERS, you need a disciplined operational process to actually execute and manage the trade. This is where the S&IPE framework comes in. It defines the 5 non-negotiable processes of a robust trading system.
Okay, let's break that down.
S is for search and scan. This is the widest part of the funnel. You apply general criteria like liquidity, ADR, and basic growth filters to generate a broad list of candidates.
Then N for narrow.
You quickly filter that list, focusing intensely only on the stocks that are currently exhibiting those high conviction edges and the characteristics of institutional accumulation. Then I-Feller is for identify. You finalize your watch lists, zeroing in on specific patterns and confirming that a setup is imminent.
And here's the crucial step that so many people skip. P is for plan.
Yes, this is the non-negotiable step that stage 1 and 2 traders almost always miss. Before the market opens, before you pull the trigger, you must clearly define your entry tactic, your exact dollar stop-loss location, and your precise position size before you enter the trade. No ambiguity allowed.
And the last letter.
And E is for execute. You enter the trade, and you manage the position according to your predefined rules. The key here is not perfection. It's adherence to the plan you just made.
Let's zoom in on edges again, because this is really where conviction comes from. Having an edge means having a positive winning expectation over time. And here is the core mechanism of the system. Edges dictate position sizing.
Precisely. This links risk management directly to your conviction level. If a stock shows only one edge, say high growth but no clear setup yet, you might only allocate your pilot position. Maybe that's $10,000 in a $100,000 portfolio.
But if it has more?
If the stock displays 4 key edges, strong growth, a clear end factor, high relative strengths, and a launchpad setup, you increase the capital allocated significantly. This is progressive exposure applied at the individual stock level. You allocate more capital only when the market provides more objective evidence, more edges, that the trade has high potential.
And the authors define some specific high probability edges.
They do. First, you have the high volume edges, HVE, HVIPO, HV1. These are volume signatures that indicate institutional desperation or commitment. We're talking the highest volume ever, the highest since the IPO, or the highest in 1 year.
And they're most powerful when?
When they're associated with a genuine game-changing catalyst, like TSLA's surprise profit in factory news in 2019. That signaled a massive institutional revaluation and led to a 200% move. These are the tracks of the elephants moving into the room.
Okay, another one is the N factor edge.
The N factor edge.
Yeah.
This is the fundamental game-changing catalyst, an EPS or revenue surprise that fundamentally shifts the growth trajectory, a major tech advance, a new product. This factor has to lead to demonstrable, measurable growth.
Like Netflix.
Think of Netflix's multiple reinventions, from streaming to original content. Each of those acted as an N factor driving multi-month uptrends. If the catalyst is just a rumor or future hope without current financial evidence, it's not a true N factor edge.
And the last one is the relative strength edge.
The relative strength edge. The stock must display visible, sustained outperformance during corrections. The RS line should be strong, making new highs ahead of price. The ZM 2020 example is perfect. The stock held its 21 EMA and consolidated tightly while the index were getting crushed. That resilience is the edge that earns larger sizing.
Once we've identified the high potential stock and confirmed the edges, we wait patiently for the setup. The authors focus on 3 core setups, which are repeatable chart patterns signifying a strong risk-reward ratio.
And they allow for that tight, logical risk management.
First is the launchpad setup. This usually formed after a severe market correction or a bear market. It's defined by the convergence of key moving averages, the 10 SMA, 21 EMA, 50 SMA, and 200 SMA, as the stock consolidates and forms a reliable bottom.
NVDA in early 2023, before it advanced 400%, is cited as a textbook example. All the various institutional time horizons finally aligned. That convergence is a powerful sign because when key MAs cluster together, it signifies that buyers and sellers across different time frames are finding perfect equilibrium.
So volatility just collapses.
Volatility collapses, and the potential energy for a coordinated explosive move is maximized. That sets the launchpad stage.
Okay, second is the gapper setup. This involves a significant price gap up on large volume, always associated with an overwhelming catalyst, most often earnings.
And the critical rule here is to focus on the first 1 or 2 gaps in a new trend. Later gaps are highly likely to be exhaustion moves or profit-taking opportunities. ELF in 2022, accelerating its EPS growth via these clean gapper setups, exemplifies this pattern leading to massive, sustained gains.
And third, the foundational setup. The base breakout setup. This is the classic O'Neill setup, a multi-week consolidation, minimum 5 weeks, that follows a powerful prior move, all within a longer-term uptrend.
And the key is looking for a clean move to the established resistance pivot and a sharp pickup in volume. Those elephant tracks indicating big money is confirming the end of the consolidation.
So how do you manage risk in these setups? You need precise enter tactics.
Right. These are short-term patterns used not just to enter, but specifically to build a position and manage risk tightly. For instance, Ross Haber developed the consolidation pivot breakout to enter slightly earlier than the traditional base break.
Why do that? What's the advantage?
It allows you to build a full position and gain a small profit cushion before the more obvious traditional base pivot is breached. That traditional pivot often faces immediate sharp selling pressure from short sellers defending that obvious line.
That makes a lot of sense. What are some other tactics?
There's the key support level reclaim, where a stock undercuts a major technical level and then immediately surges back up, a clear failure for sellers. Another is the oops reversal, a Larry Williams pattern where a stock gaps down below the prior day's low, only to immediately reverse and push back up.
It traps the shorts.
It forces short sellers into a panic cover. The discipline is simple. If you cannot place a tight and logical stop loss based on a defined entry tactic, you have to wait patiently for the setup to ripen and present a clear, objective entry point.
We move now to what the authors themselves call the most important chapter in the entire book. Chapter 6 on risk management.
This is everything.
It's the non-negotiable skill that allows for longevity, for compounding, and for protecting both principal and profits over decades of trading.
This is where we move past the philosophy and into actionable, objective process. They define total risk based on 3 factors, all of them completely within your control.
What are they?
The number of open positions you hold, the size of those individual positions, and the distance to their respective stop-loss locations.
And they provide a clear, actionable calculation that has to be used daily. Total open risk in dollars, the sum of position size distance to stop-loss percent.
Right, and let's look at the critical implication of that formula because it drives your behavior.
Yeah.
Imagine a $100,000 account. In a full raging bull market where your setups are working flawlessly, you might have 5 large positions, each size at $20,000.
Yeah.
If your average distance to the stop loss is 3%, your total exposure to risk is $100,000 times 3%, which is $3,000 or 2% of your equity. You might even accept a bit higher, maybe 4% to 5% total open risk in truly ideal conditions.
But now contrast that with a choppy, volatile market.
Suddenly, your position sizes have to shrink. You might only have 2 small pilot trades, totaling maybe $20,000 in position size, with wider stops averaging 5% because the volatility is higher. Your total open dollar risk is now only $1,000, or 1% of your account.
This highlights the concept of progressive exposure. Trading your largest when market conditions are best and your personal trading is hot, and sizing down severely when conditions are worst or your system is in a drawdown.
This risk dial has to constantly fluctuate based on objective market feedback. If the market weakens, you lower total risk. You decrease the number of positions, cutting your lowest conviction D's grades first. You decrease the size of what's left, or you tighten your stops.
So this raises an important question. If your total open risk is low, say 1%, and the market begins a new uptrend, how do you manage that ramp up?
You don't jump to 5% risk overnight. You increase exposure incrementally, maybe to 1.5%, and only if the new trades provide immediate positive feedback.
Meaning they move quickly into profit.
Exactly. The market forces you to earn the right to increase your capital allocation.
Now let's drill down into the most fundamental aspect of position management, setting tight and logical stop losses.
A stop has to be 2 things. First, it must be tight. It has to limit the loss on the position to an acceptable few percent, typically 1% to 4% for average growth stocks, maybe up to 6% for extremely volatile names.
And there's a rule of thumb for this.
Critically, the authors state that your initial stop-loss percentage should be about 1/3 your average gain percentage. This ensures that your average winner covers at least 3 average losers, securing that positive risk-reward ratio.
And the second thing a stop must be.
It must also be logical. A violation of the stop level must invalidate your original thesis. If the stock loses a respected moving average that anchored your entry, or if it undercuts the low of the entry range, the setup has failed for now.
And you place the stop immediately.
Immediately upon entry. And in choppy, fast-moving markets, you don't wait until the end of the day to see if it closes below the level. You execute when the level is breached.
That requires significant psychological discipline, executing a loss without any hesitation.
It does, which is why the entry has to be clean. If you are stopped out, provided the original setup thesis is still valid, let's say the base holds and volume remains low, you must be willing to re-enter. The market often performs head fakes, and a good trader accepts small losses and re-enters, rather than letting a small loss become a large, uncontrolled one.
Okay, so once the trade is on and working, we move to adjusting and trailing stops to protect profits.
The first rule is simple. When your profit is 2 to 3 times your initial stop loss, so 2R or 3R, you raise the stop to your cost basis. break even.
So at that point, you've eliminated the risk of loss.
You've eliminated the risk of loss on that specific trade, freeing up mental and financial capital.
And to capture the bulk of the trend,
To capture the trend, trailing stops are essential. The authors favor using a key moving average, like the 21 EMA for swing traders, or the 50 SMA for position traders. And they recommend a crucial, practical rule of thumb. Wait for 2 closes below the moving average to signal that the stop has been activated.
why specifically 2 closes, not just 1? That's an interesting detail.
That's a crucial distinction. The requirement for 2 closes is designed to mitigate noise, whipsaws, and volatility. A single close below a key MA is often just market noise, a slight undercut that traps nervous traders.
So the second close confirms it.
By requiring the second close, you confirm that the institutional flow has likely shifted and the stock is demonstrating a new, weaker character. Psychologically, this rule helps a trader hold through minor corrections and prevents getting shaken out too early in a powerful trend, which is a classic mistake of stage 2 traders.
This brings us to a style decision. Selling into strength versus weakness.
Right? Swing traders often sell more into strength for quicker, defined profits. Position traders, however, they have to sell more into weakness. They ride the trend until the technical structure definitively breaks down, accepting larger but controlled drawdowns in exchange for capturing those massive home runs.
For stage 1 and 2 traders, the guidance needs to be rigid. The focus is purely on consistency and capital preservation, not on maximizing profit.
Absolutely.
So the rigid rule: sell half the position at 5% profit, immediately raise the stop to break even on the balance, and then trail the rest using a specific MA, like the 21 EMA, and that non-negotiable 2 closes below rule.
The goal isn't maximum profit, it's capital protection, reinforcing discipline, and gaining that mechanical consistency.
But stage 3 traders can be more nuanced.
Stage 3 traders move to maximizing gains by applying nuanced rules and judgment. They should do much less proactive selling early in a cycle. Instead, they use their judgment, maybe ignoring a slight undercut of the MA on low volume if the second close is high, but they proactively sell into strength only late in a cycle, when a stock appears visually extended and is running into a classic climax top.
That signals an imminent, steep reversal.
Exactly. And the power of technical conviction, even against glowing fundamentals, is just brilliantly illustrated by that Ross Haber anecdote from the book.
Oh, the Schwab story.
It's the ultimate lesson in objectivity. Haber sold his entire Charles Schwab position in April 1999. At the time, the fundamentals were glowing. Every analyst on TV was cheering the stock. It seemed unstoppable.
But the chart said something different.
The technicals revealed it was forming a definitive climax top after a monumental 400% run in just 24 weeks. He sold immediately, based purely on the chart action and the volume exhaustion patterns, just before the stock fell 65% in 6 months and 87% in the ensuing bear market.
So the key overarching rule is never fall in love with a stock. Sell when the technicals break down, regardless of the perceived glowing fundamentals or what everyone else is saying. That's the discipline that separates consistency from the boom and bust cycle.
Now, moving into overall strategy, the authors emphasize that at least 50% of your trading success comes directly from the general market trend.
If you fight the trend.
Your performance suffers disproportionately.
Yeah.
Cycles are non-negotiable. They're driven by technical liquidity and that recurring human psychology of fear and greed.
So how do we operationalize the market cycle? How do we translate this macro awareness into actual trading decisions?
You need a system based on clear, easy-to-interpret criteria aligned with your specific time frame. For swing traders, the suggested system uses a benchmark ETF, like the QQQ and the 21 EMA. The market cycle begins on a close above the rising MA and ends on 2 confirmed closes below it.
And that objective rule dictates your exposure.
It dictates everything. When the cycle's off, your exposure is severely limited or you're sitting entirely in cash.
And when the cycle begins.
You initially test the waters with small pilot positions. You only increase exposure, that progressive exposure we talked about, in response to immediate positive feedback. It's also absolutely crucial to anticipate the stress tests.
What are those?
Sudden, sharp down days that generally occur early in the cycle, often around days 4 to 6 of a new rally. How the general market, and more importantly, how your leading stocks handle that first sharp bout of selling, tells you a great deal about the strength and longevity of the rally. If your leaders fail that stress test, the cycle may be premature.
Now that we've established the system in the market context, let's talk about the maintenance and feedback loops, post-analysis, and the trading rule set. The authors use a powerful analogy from baseball here.
They do. It's very effective.
They call it the free bases concept, like a baseball coach trying to minimize unforced errors, walks, dropped balls. A trader must minimize free bases by identifying and eliminating fundamental self-inflicted mistakes.
Things like violating your stop-loss rule or trading based on some unapproved social media tip. You gain these painful but crucial insights through disciplined trade analysis.
This raises an important question. What specifically should we be analyzing in our journal?
The authors suggest prioritizing the 5 best and 10 worst trades by return percentage. You have to review the charts at the moment of entry and exit to objectively assess your execution quality. Was the entry late, pushing the stop further away? Was the exit due to panic, violating the 2 closes rule? Was the position size too large for the number of edges present?
And what are the key analytics to track?
You have to track and manage your batting average, your win rate, your average gain-loss, and most importantly, your risk-reward ratio, targeting 2.1 or higher.
And the biggest, fastest improvement for most traders.
It often comes from focusing intensely on reducing your max loss to bring it closer to your average loss. Just eliminating that tail end of devastating uncontrolled losses dramatically improves your overall RR ratio and protects your equity curve.
And all this rigorous feedback then feeds the rule set. This set has to be written down. It has to be clear, specific, and deep. It's not a mental checklist.
It's a living document that gets updated via your post-analysis. It ensures consistency and prevents emotional trading. And the rules need to cover every conceivable aspect: market analysis, stock selection, tigers, edge setups, risk management, sell rules, post-analysis.
And the one everyone forgets.
The one everyone forgets. Contingency planning. What do you do if your internet goes down? If your broker malfunctions? Or if a stock gap's down 15% below your hard stop on unforeseen news? You have to plan for the worst-case scenario before it actually happens. You need an objective playbook for chaos.
Finally, the journey to mastery is one of continuous learning. How do successful traders continue finding new edges and setups when the market is constantly evolving?
Through disciplined trading studies and building model books. Trading studies focus on a specific, curious idea. For instance, investigating the precise success rate of the gapper setup during low volatility versus high volatility market phases. You define the scope, collect precise data, and you plot performance versus characteristics, strictly allowing the data to guide your conclusion, not your preconceived notions.
And what about model books?
Building model books is even more foundational for building that market intuition. This is a meticulous compilation of the highest quality, best performing stocks over a specific period. Like O'Neill's documented focus on textbook cancelum stocks in the 1998-2000 period.
So it serves as a historical reference.
It's a detailed historical precedent. You annotate the charts with entries, exits, volume spikes, relative strength lines. By studying historical greatness, you effectively build a blueprint in your mind for what future winners will look like. It makes pattern recognition almost instantaneous.
It sounds like the successful trader cycle is: learn from historical data, trade according to objective rules, analyze the performance, adjust the rules based on the data, and then repeat indefinitely. So today, we've covered the comprehensive blueprint for moving from that random boom and bust trading to consistent professional performance. We started with the foundational mindset, the 5 key principles, and the 4 critical stages of the trader's journey, defined by the objective reality of your equity curve.
We detailed the market's language, the importance of clean charts, mastering volume analysis and the closing range formula, and identifying those winning characteristics that reliably mark institutional accumulation. And crucially, we laid out the Tigers and SNIPE frameworks for disciplined selection and flawless execution.
And we dedicated significant time to the true core of longevity: risk management. This includes calculating your total open risk based on progressive exposure and implementing tight, logical stops, knowing that you must earn the right to size up your capital through demonstrable discipline and consistency.
The journey to trading mastery is not a sprint. It's an arduous endeavor that requires multiple market cycles. It demands objectivity, relentless self-analysis via that free basis concept, and an infallible written system that governs your every move.
So here is our final reflective thought for you to chew on as you start applying these lessons. The next great market leaders, the stocks that will double and triple, are already being accumulated right now. They are forming bases, flashing high volume edges, and displaying persistent relative strength.
Your ability to identify them early and hold them through volatility depends entirely on your commitment to studying your own weaknesses, adjusting your rules, and developing that objective, infallible system.
Will you be ready to apply these hard-won lessons when the next great opportunity presents itself, or will you still be stuck in stage two? Thank you for joining us for this deep dive into the winning habits and routines of successful traders. We'll see you next time.